I'm Marlo Campos, and this is my video for Peachtree Case A. Number 1, the T-bond return in Table 1 is shown to be independent of the state of the economy because it's a fixed interest debt security that must meet the par value despite what the economic conditions may be. The return on a 1-year bond is not considered to be completely free of risk, while returns are considered to be reliant on current economic conditions, are not considered to be reliant on economic conditions. Inflation and interest rate risks do exist. For number 2, I calculated the expected rate of returns across the 4 different funds. For the T-bonds, I got 8%, TECO 13.5%, and Gold Hill 8.8%, and the S&P 500 fund 15%. Now, based just solely on these expected returns, one would probably gravitate towards the S&P 500 fund because it has the highest calculated rate of return of 15%. For number 3, I calculated the standard deviation and relative coefficients for the 4 different funds. So standard deviations for the T-bond, I got practically 0, 1.38 to the negative 17th exponent, TECO 0.117, Gold Hill 0.09, and S&P 0.164. Now the relative risk coefficients for T-bond, I got, again, almost 0, 1.73 to the negative 16th exponent, for TECO 0.86, for Gold Hill 1.03, and for the S&P 500 fund 1.095. Now the standard deviation is the square root of the variance, and it's used to measure the amount of expected return in the form of volatility. Coefficient of variation measures the dispersion of probability distribution or frequency distribution and is calculated by dividing standard deviation by expected returns. Standard deviation is the more accurate measure of risk between the two, but the coefficient of variation may be more informational when looking at more than one asset. When looking at risk, something that stands out is the very small numbers near 0 for the risk, that is the standard deviation, and the risk coefficient of T-bonds. The next lowest calculated risk noted was TECO, followed by Gold Hill, and then S&P 500. For number 4, I looked at what the portfolio's expected rate of return would be for a portfolio that had 50% in Gold Hill and 50% in TECO. So I calculated a covariance of 0.00932 that I then was able to put to calculate the variance, square root it, and I got the standard deviation of 0.0289 and the relative risk coefficient of 0.25. When comparing the portfolio's numbers to the Gold Hill and TECO individual stocks, one notices that the risk goes down. Now, risk reduction is possible because possibly just diversification. For, let's see, Part D, I looked at a portfolio that had 75% in Gold Hill and 25% in TECO. So the portfolio's expected return is then 9.98 with a standard deviation of 0.044 and a relative risk coefficient variation of 0.449. And then swapping it, same portfolio assets, but in 25% in Gold Hill and 75% in TECO, the portfolio's expected rate of return jumps up to 12.33% with a standard deviation of 0.068 and a relative risk coefficient of 0.55. And then for number 5, I did 50% and 50% in a portfolio with S&P 500 and with TECO, and I got the portfolio's expected rate of return of 14.25 with a standard deviation of 0.14 and a relative risk coefficient of 0.98. And this one did not have the same risk-reducing effect from the previous problem, and yeah. So let's see the next one. Having a higher number of diversification assets across different sectors or random stocks can increase the chances of maintaining a relatively less risky portfolio. Investors should also make sure that they're gathering these diverse stocks. They need to be aware that a portfolio must be looked at not as just individual stocks, but as one whole collective entity. The cost of capital will be affected if the right assets to the portfolio are gathered, or rather, if they're not gathered, it will be affected. And total risk is diversifiable plus non-diversifiable risk. Non-diversifiable or market risk are uncontrollable risks, and diversifiable risks can be eliminated. Only having a single stock, an investor should expect to bear all risks associated with that one stock. One must realize that risk and returns are related, so the higher risk yields the higher returns, and vice versa. For the next one, I did graphs putting the funds against the S&P 500, and one can see that TECO is consistently increasing. T-bond stays the same at their 8% yield, and Gold Hill goes up and then jumps down and then goes back up again. Those graphs will be in my Excel document. Number 8, the security market line. So I graphed the T-bond line and put where TECO lands on the security market line. And so using the CAPM model, I calculated the required rate of return as being 12.2%. And that's less than the expected return of 13.5%, which is a good thing, hinting towards TECO being a relatively good investment. Number 9, if TECO's rate of return is increased by 3%, its required rate of return increases from 12.2 to 13.4%. And then Part B, if a market risk premium is increased from 7 to 8%, then the required rate of return increases from 12.2 to 12.8. If beta is increased from 0.6 to 1, then the required rate of return will rise from 12.2 to 15%. And all of those we're still using the CAPM model, just replacing numbers. The efficient market of hypothesis states that stocks are always in equilibrium. Stock market efficiency causes, quote, existing share prices to always incorporate and reflect all relevant information. So because of this, it is impossible for any single individual to, quote, beat the market. This concept does not consider plant and operation equipment, so it's not applicable. Since stock prices are reflected from public information, they are fairly valued, so the efficient market hypothesis does affect corporate decisions. Since Jake Taylor will be adding to his staff of security analysts and he should be considering someone that is familiar with the efficient market risk hypothesis, or the efficient market hypothesis, because of its current track record. Number 10, if TECO's long-term debt ratio was to decrease and continue decreasing, they will not own as much debt as they did before. So their beta, their riskiness, and their required rate of return on equity can be expected to decrease as well. And that is it. Thank you.